If we cast our minds back to 2020, we'll remember it as a year marked by major challenges for the global economy and consequently for the global real estate sector. As lockdown restrictions were enforced in most countries, retailers selling non-essential goods were forced to close their physical stores, while corporates moved their employees to remote working environments to protect them against contracting the virus. The natural result of that sudden halt in trading and economic activity meant that some retail, corporate, and industrial tenants could not generate sufficient cash flows to honor their rental obligations. If you fast forward to the first week of November 2020, we saw renewed hope for economic activity across the globe, with several biopharmaceutical companies announcing that their vaccine candidates demonstrated efficacy against COVID-19. To date, we have seen a ramp up in vaccinations across the world, resulting in a significant share of populations being fully vaccinated against COVID-19. Having said that, the rate of vaccinations differs by country, and that has a bearing on the overall recovery of those economies and demand for real estate space. We are seeing developed economies with higher rates of vaccinations showing improved demand for real estate space, while developing economies with lower vaccination rates are lagging in that recovery. If we revisit the performance of the South African listed property sector for the 10 months ended October 2020, we saw a sector that incurred capital losses of approximately 51% over the period. However, we saw a strong rebound in real estate equity markets globally and locally from the beginning of November 2020 on the back of positive vaccine developments, and that rally has largely been carried over into the 2021 calendar year. With that, we've seen 4 consecutive quarters of positive returns from the South African listed property sector, resulting in total returns of approximately 30% year to date. There is a huge margin of outperformance relative to other asset classes, indicating that the sector was oversold throughout most of 2020. On the ground, we saw the development and acceleration of a few themes which continue to unfold. I guess some of these themes are cyclical in nature, but others are structural and will inform how various subsectors of the real estate asset class perform in future and the kind of investment returns investors will likely generate from the asset class going forward. One of the key investment debates affecting the office sector currently is whether remote working will affect long-term tenant demand for office space. We think that the catalyst that is required to shape the outcome of this debate is the rate of vaccinations. So in our view, the experience will be different depending on where a country is in respect of its vaccination rollout program and its real estate investment cycle. If you look at global leasing activity, we saw global office leasing volumes increasing by 39% in the third quarter of 2021. Although these leasing volumes look strong, they are approximately 25% lower than comparable volumes in 2019. The read-through for us, however, is that this pickup in leasing volumes provides some evidence that sentiment in some real estate markets has improved on the back of vaccinations, and that remote working is unlikely to drive long-term reductions in demand for office space. Some markets, however, will take longer to recover from the pandemic. While we've seen encouraging progress as far as vaccinations are concerned in South Africa, the share of people vaccinated in the country remains low in absolute terms and relative to other countries. As a result, leasing volumes in the South African office market remain at historically low levels, as most tenants are taking longer to commit to space, largely due to the uncertainty that COVID-19 has brought. Likewise, with the weak trading environment that we've seen in the country over the last number of years, corporates continue to gradually shrink their office space requirements with the objective of reducing costs. Judging by some of the announcements from large office occupiers, this trend does not seem to be losing momentum, and that does not bode well for the office market in South Africa, which was already under pressure prior to the pandemic. We have, as a result, seen vacancy rates increasing to in excess of around 15%, which is the highest level of vacancy rates that we've seen in 2003, and pressure has been evident across all property types from P-grade to C-grade properties. Although the retail sector was impacted the most by lockdowns, what has been pleasing to see over the last number of months has been the decent recovery in visits to shopping centers, which has contributed to the recovery in retail sales. One of the themes that has emerged in South Africa since the outbreak of the pandemic has been the divergence in performance that we have seen between some of the retail formats. Shopping centers weighted towards selling essential goods and those servicing township communities were impacted the least and recovered quicker coming out of the lockdowns, given the high proportion of value and non-discretionary products sold in those centers. As a result, we've seen them outperforming regional and super-regional shopping centers, which generally have a higher allocation of tenants that sell non-discretionary goods. In the medium term, we think that convenience and township retail will outperform. The resilience of some of the township retail shopping centres, however, was dampened somewhat by the unrest that we saw in parts of KwaZulu-Natal and Gauteng provinces in July, with Sasria estimating that the cost of that damage could be approximately 20 billion rands. Although most of the listed property companies are insured against loss of income and destruction to properties, some of the independent retailers were not insured and may not be able to reopen their stores once malls are ready to trade. While tenant demand for office and retail space has been interrupted by COVID-19, the pandemic has certainly accelerated the adoption of online-based retailing and structurally accelerated demand for warehousing and logistics space. Looking at research conducted by CBRE, they estimate that between 2015 and 2020, total global retail sales grew by 7% from $12.6 trillion to $13.5 trillion. Over the same period, online retail trade grew by approximately 140% and is projected to grow by more than 60% between 2020 and 2025. So this share shift in retail sales away from brick and mortar retail to online retail is proving to be negative for shopping centers while acting as a tailwind for warehousing and the logistics sector. As a result, we've seen strong tenant demand for warehousing and logistics on the back of e-commerce penetration and record amounts of institutional capital making its way into the sector. We think that strong rental and capital value growth expectations on the back of positive fundamentals will continue to attract investment capital into the sector in the medium term. However, investors will need to pay close attention to real estate fundamentals so not to end up overpaying for exposure into the sector at a wrong time in the cycle. In terms of fund positioning, we continue to favor property companies operating in countries with higher economic growth projections and favorable real estate demand and supply dynamics. So if you look at our portfolio positioning relative to the benchmark, we believe there's still good value to be had in JSE-listed property companies operating in Australia, Germany, and CEE regions of Poland and Romania, and this informs our overall positions in those regions. In the CEE, we expect the impact of high structural growth in the economy, high consumer expenditure coupled with low unemployment rates relative to Western European averages to benefit retail property companies operating in those regions. So broadly speaking, looking at our investable universe, we expect retail-focused property companies operating in Central Eastern Europe to outperform SA and UK retail property companies in terms of income growth and asset value appreciation. Our entry point into Germany is through a leading owner and operator of business parks, offices, and industrial complexes with a strong record of shareholder value creation. The resilience of this business model was tested during the pandemic, and our portfolios continue to benefit from the robust operational performance from the company, which is translating into strong shareholder returns. We think some REITs and property companies operating in South Africa and the UK face a couple of headwinds, which makes us less excited about those opportunities. As a result, we maintain an underweight positions in those regions. These asset allocation calls have proven beneficial for the portfolio so far this year, with the portfolio delivering good absolute performance and alpha relative to our benchmark. Given the headwinds expected from the South African real estate market, we will continue to favor well-capitalized and attractively valued property companies which operate in growing economies and are expected to benefit from favorable real estate fundamentals. With that, we thank you for your continued support and wish you and your families a great festive season.